Hello, everyone, and welcome back to Synaptic Investing.
Mm.
Hope you're having a fantastic week and are ready for another deep dive. We have been looking forward to this one because it touches on a sector that, everybody sees, everybody drives past, but very few people actually stop to understand the mechanics of.
Oh, yeah. It's hiding in plain sight.
Totally. Today, we're breaking down one of the most fascinating companies on the market, the self-storage titan, Extra Space Storage, ticker symbol EXR. Now, before you roll your eyes and think storage, really, just hear me out.
I think they know by now to trust the process.
Exactly. This isn't just about renting out garage space. We are talking about a dominant player in the REIT space, a massive large-cap entity with a market cap sitting right around, what, $31 billion?
That's a behemoth.
It is. And on the surface, it looks like maybe the most boring business in the world. You build a concrete box, you put a padlock on it, and you collect a check. Simple. But the real question for us as long-term investors is this. Is Extra Space Storage actually a compounding machine protected by a really wide moat, a black box of wealth creation, or are there hidden cracks in that fortress? I mean, we're seeing interest rate volatility. We're hearing all this chatter about oversupply. Is this a classic value trap waiting to snap shut, or is it a long-term winner hiding in plain sight?
That's the billion-dollar question, isn't it?
That's what we're here to find out.
That's a huge topic, and frankly, the boring businesses are often where the most complex mechanics are hiding. Before we dive deep, quick heads up for the audience.
Right. So if you're looking to invest, whether it's in REITs like EXR or anything else we cover, we use Interactive Brokers. It's our platform of choice for execution.
Yep.
Use the link in the description for a stock bonus when you sign up.
It's really the best way to get a bonus and support the channel at the same time. They have great execution, low costs, which really matters when you're compounding over years.
And while you're there, please like, subscribe, and let us know your questions in the comments. We actually do read them, and they help shape future deep dives.
Now, let's get into it. Pillar number one, the business model. And, you mentioned the boring nature of the business, but I want to challenge that immediately.
Okay.
The business model isn't boring, it's predatory. And I mean that in the most complimentary capitalist sense of the word.
Predatory. Whoa, that is a strong opening. Let's go.
It is. Because when we look at the engine of Extra Space Storage, we aren't just looking at real estate, we are looking at a psychological arbitrage play.
Okay, let's unpack that.
Yeah.
When you say arbitrage, you're referring to the unit economics, the black box of concrete arbitrage, as you put it.
Exactly. I mean, think about what this asset actually is. It's 4 walls, a concrete floor, and a roll-up steel door. That's it. Unlike an apartment complex, you don't have toilets clogging at midnight. You don't have carpets to replace every 2 years. You don't have, strict habitability laws that require you to keep the temperature at 72 degrees.
The maintenance capex is practically zero.
It's negligible.
Yeah.
But the demand side, that's where the psychology really comes into play. In the industry, they always talk about the 4 Ds.
The 4 Ds: death, divorce, dislocation, and downsizing.
It sounds like a Grim Reaper's to-do list, doesn't it?
It really does, and I think that's the point. It's all stress-driven.
It is, and I want you, the listener, to really visualize this. Nobody, and I mean absolutely nobody, wakes up on a beautiful Saturday morning, grabs a coffee, and thinks, it'd be fun today. Let's go rent a 10 by 10 dark room to put our old junk in.
Never happens. It's not a want, it's a need.
It is never a proactive purchase. It is almost exclusively a reactive purchase driven by trauma or stress.
That is such a crucial distinction. If I'm buying a new TV, I'm excited. I'm comparing models. I check prices at Best Buy and Amazon. I'm price sensitive because I have the luxury of time and, a clear head.
Precisely. But if you are getting divorced, you need to be out of the house by Friday. If a parent just passed away and you sold their house, but you just can't bear to throw away their photo albums and antique furniture, you're emotional. You are not optimizing for price.
No.
You are optimizing for immediate relief. You just want the problem solved.
Now, so EXR knows this. They understand that you're coming to them in a vulnerable state where price is, maybe third or fourth on your list of concerns. Convenience is number one.
And that is exactly how they structure the pricing. The initial monthly, let's say it's $150, is designed to be just low enough that it doesn't trigger a financial alarm bell.
Right.
It's a subscription to make a headache go away.
But here's the thing I've always kind of struggled with. If it's just for a divorce or a move, shouldn't the average rental duration be really short, like,
2 or 3 months.
You would absolutely think so. It seems logical. But the data shows the average stay is actually around 14 to 16 months.
Wow.
And this is where the trap is sprung. The stickiness of the customer is just incredible, and it leads us to the most important acronym of this entire deep dive, ECRI.
ECRI. The existing customer rate increase. This is the secret sauce.
It's the algorithm that just prints money.
Yeah.
I was looking at the divergence in their data recently, and it is absolutely staggering.
Okay, walk us through that divergence because it's so counterintuitive.
Okay, so you have what are called street rates. This is the price advertised on Google or on the big banner outside the facility to get a new customer in the door.
The introductory offer.
Exactly. And recently, because of some oversupply issues we'll get into later, street rates have been plummeting. In some quarters, down 9 or 10% year over year. They are discounting heavily to acquire you. So if I'm an investor and I'm just looking at that headline, street rates number, I am panicking. I'm thinking their pricing power is gone. The business is in trouble.
Exactly. You'd think the business is collapsing, but then you look at same-store revenue, the actual cash coming in from the properties they've owned for a while, and it's flat to slightly up.
How is that even mathematically possible?
It's the bait and switch.
It's the ECRI.
It's the ECRI.
Yeah.
You sign up at that discounted $100 rate, you move all your heavy boxes in, you sweat, you rent the U-Haul, you buy the pizza for your friends who helped, you lock the door. 5 or 6 months later, you get a little notification. Due to market conditions, your rate is now $135.
And what do?
You do absolutely nothing.
Because the friction, the pure hassle of leaving is just too high.
This is what I call the physical moat. It is not a digital moat like, switching your software subscription. It is a physical, sweaty, miserable moat. Are you really going to take a Saturday off work, rent another truck, lift that heavy mattress again just to save $35 a month down the street? No.
No way. You do the mental math and you say, ugh, I'll deal with it later.
And later becomes another 6 months and then another rate hike.
So in a way, that street rate is just a customer acquisition cost, a CAC.
Yeah.
They can afford to lose money on you for the first 3 months.
Yeah.
Because the lifetime value, the LTV, is all backloaded through these aggressive algorithmic rate hikes.
Precisely. It is an inertia tax. They are literally taxing your laziness and your desire to avoid physical labor. And the fact that their revenue held up while street rates collapsed, that proves this switching cost is incredibly real. It's one of the strongest behavioral moats in the entire market.
But hold on. A behavioral moat is great, but it doesn't stop competition. I mean, if the guy next door builds a brand new facility and charges half the price, eventually that friction is overcome.
Right.
This brings us to the structural changes in the company.
Yeah.
We have to talk about scale, and specifically that massive landscape-altering merger with Life Storage.
That deal, it wasn't just an acquisition, it was a coronation. It cemented their position.
It really was. Post-merger, Extra Space Storage is now the largest operator in the United States by location count. They have over 3,700 properties.
More dots on the map than even Public Storage, which is kind of amazing.
It is, but I want to push back on the idea that scale just means more buildings. In the old world, scale meant you could buy light bulbs cheaper because you bought them in bulk. That's not what it means here.
No, in the modern world, scale is about data and aggregation theory.
Ben Thompson's aggregation theory. I love when we apply these tech frameworks to, concrete boxes.
Because it applies perfectly here. Thompson's whole argument is that in the digital age, whoever controls the interface with the customer controls the entire value chain.
And in this industry, the interface isn't some dusty leasing office anymore. It's Google.
It's the search bar on your phone. When you're stressed out and you need storage, you type "storage near me" into your phone. And EXR spends millions upon millions of dollars on search engine optimization and paid bidding. They own the top 3 results.
So they effectively control the demand funnel.
Correct. And this completely commoditizes the supply. If you are a mom-and-pop operator with one beautiful, clean facility, you cannot compete with EXR's digital marketing budget. You might have a better building, but you are functionally invisible on the digital shelf.
This leads to what I think is the most brilliant, almost diabolical part of their strategy, the third-party management flywheel. This is the anti-moat check for me.
It's the if you can't beat them, join them model, except it's forced upon the competition.
Yeah, explain how that works, because usually competitors fight each other. Here, EXR seems to be just absorbing them.
Okay, so think about that mom and pop owner. They built a nice facility, but they can't fill it because they don't rank on Google. Their occupancy is 60%. They're bleeding cash every month.
They're in trouble.
They're desperate. So EXR comes knocking on the door and says, look, we can fill this place up. We'll put our big green extra space storage sign on your door. We'll put your inventory on our website. We'll use our call center to answer your phones. We will manage this entire property for you for a fee.
And the owner says yes because the alternative is literally bankruptcy.
They surrender. They become a franchisee, effectively. Yep. But here's the flywheel part, the really genius part.
Yeah.
Every time EXR adds a third-party store, they get more data. They see pricing trends in a new neighborhood. They see customer behavior. That data feeds back into the algorithm, which makes their pricing even smarter, which lowers their overall customer acquisition costs.
It allows them to bid even more aggressively on Google.
Which forces more mom and pops to capitulate and join the platform because they can't keep up.
It's this incredible positive feedback loop. The bigger they get, the harder it is for anyone else to compete.
It completely transforms them from a simple real estate company into a data platform that just happens to rent concrete. They are aggregating the entire fragmented industry onto their operating system.
That sounds fantastic strategically, but you and I know we have to see if it actually shows up in the bank account.
Oh.
So let's move to financial health and quality of earnings.
Right.
Because scale is often just a code word for empire building by CEOs who just want to be on the cover of a magazine.
That is always the risk, and we have to check for that. But when you look at the margins here, they are truly elite. I mean, we are talking gross margins north of 70%.
That is approaching SaaS territory. Software as a service. It's wild.
It's wild for a physical asset business.
But we have seen some compression lately, haven't we? I mean, operating margins have dipped a bit.
They have, yeah. And we have to be honest about the headwinds. Property taxes are up. Local governments are hungry for revenue. Insurance premiums have skyrocketed across the board for everyone.
Mm-hmm.
And those marketing battles on Google, they are getting more expensive. So yes, there are headwinds. But the core net operating income, the NOI, is just incredibly resilient.
And a lot of that comes down to their operational culture, which is fascinating. I've read through like hundreds of Glassdoor reviews and industry forums. The consensus is that EXR runs an incredibly lean ship.
Lean might be a nice way of putting it. Understaffed might be what the site managers say.
That's a fair point. I saw a lot of that too.
They often use a hub and spoke model where one manager oversees multiple properties remotely, or they'll have kiosks and automated entry systems instead of people.
Right.
It's definitely tough on the employees sometimes, but for the shareholder, that process power translates directly to efficiency and higher margins.
I want to pause here and address a technical term because we promised a deep dive. We keep saying FFO. If a listener pulls up Yahoo Finance and looks at the PE ratio for EXR, they're going to see a number that doesn't make any sense.
Right.
So why do we ignore net income for REITs? Can you break that down?
Yeah, this is absolutely critical. In standard accounting GAAP, if you own a factory or a machine, you have to depreciate it. You assume it loses value every year as it wears out, so you subtract that loss from your income.
Even though it's a non-cash expense, you didn't actually write a check for it?
Right, it's just an accounting fiction. But in real estate, well-maintained properties generally appreciate over time. They don't lose value. So GAAP accounting forces REITs to report these massive depreciation expenses that effectively lie about the business's true profitability. It makes net income look tiny, even if the cash flow is a gusher.
So funds from operations, or FFO, just adds that depreciation back in.
Exactly. It gives you a much better picture of the true cash generation capacity of the firm. And this is why I like EXR's core FFO, unlike some tech companies that invent metrics like, community-adjusted EBITDA to hide their losses.
Or they add back massive amounts of stock-based compensation.
Exactly. EXR is very disciplined. Their core FFO is clean. And speaking of stock-based comp, or SBC, they are very respectful of the shareholder. Dilution is minimal, less than 0.5% per year. They aren't treating the company's stock like a piggy bank for executives.
That's a huge green flag. And it brings us to capital allocation. The CEO has a checkbook. How is he spending the money?
Historically, they are champions at this. Their return on invested capital, ROIC, consistently hovers above 10%, while their weighted average cost of capital, their WACC, is around 6 or 7%.
And that spread.
That spread, that gap between what it costs them to get money and what they earn on it, that is the literal definition of creating value for shareholders.
But the life storage deal, That was a massive bet. $12 billion. I mean, that's a bet the company kind of move.
It was. And look, the jury is still out on the final verdict, but the early signs are that it was rational. They're projecting over $100 million in synergies.
Synergies is usually consultant speak for, we hope we can fire enough people to make the numbers work.
Usually, yes. But here, it's much more concrete. It's firing duplicate accounting teams, sure, but it's also merging 2 IT departments into one. It's getting better bulk rates on property insurance because you're now insuring 3,700 buildings instead of 2,000.
Right. Those are hard cost savings.
They are. So it really does appear to be a rational acquisition, not just empire building for the sake of it.
So if we look at their cash priorities right now, it seems to be, number 1, digest the merger. Number 2, pay that dividend.
Which is yielding around 4.5% and growing.
And number 3, pause the buybacks until the leverage comes down a bit.
That is the prudent path forward. Absolutely.
Okay, we have praised them enough.
Yeah.
I want to switch gears now. I want you to put on your red team hat. You are the short seller. You are the skeptic. Why does this stock blow up?
Gladly. Look, the first and most obvious point is the price. You are pitching me a stock trading at roughly 17.8 times forward FFO. That is a premium multiple. The peer average is closer to 16 times. So right off the bat, you're asking me to pay a premium for a commodity box provider in a high-rate environment.
It's definitely not cheap, I'll grant you that.
But the real risk isn't the multiple, it's the macro environment. We talked about the 4Ds driving demand, but what happens in a severe recession?
The purge scenario.
Exactly. When households get squeezed, I mean really squeezed, what is the first monthly subscription to go? It's not your Netflix, it's not your iPhone plan, and it's not the gym membership you feel guilty about.
It's the storage unit.
It's the storage unit holding the skis you haven't used in 3 years and your grandma's old furniture.
So vacancy spikes.
Vacancy spikes hard and fast, and because storage is a month-to-month lease, that revenue can just evaporate instantly. It's not like an office building with 10-year lease agreements. If the economy crashes tomorrow, EXR's revenue crashes next month.
And if vacancy spikes, that breaks the algorithm.
It completely breaks the ECRI model, because if the facility next door is 50% empty, what are they going to do?
Slash prices.
They're going to slash prices to $20 a month just to get some cash flow. EXR has to match that. The whole ECRI model relies on the spread between the street rates and your rate not being too insulting. If that spread gets way too wide, even with the friction, the customer finally leaves.
Okay, that leads right into the specific risk of sticky inflation and rates. We need to quickly explain the relationship between interest rates and NAV, or net asset value.
This is real estate 101, but it's what kills portfolios. Real estate is valued based on something called a cap rate. It's basically the yield you get on the property.
Right.
So if I can get 5% completely risk-free from a treasury bond, I am not going to buy a risky storage unit unless it yields me, say, 7 or 8%.
So as the risk-free rate, interest rates go up, investors demand a higher yield from real estate to compensate them for the risk.
And the only way to get a higher yield if the rent is constant is to pay a lower price for the building. So if rates stay higher for longer, the underlying value of EXR's physical assets, their net asset value mathematically, has to compress.
And they are carrying a decent amount of leverage.
4.5 times net debt to EBITDA. That isn't catastrophic, but it's not zero. If they have to refinance that debt at 6 or 7% instead of the 3 or 4% they enjoyed in the past, that interest expense eats directly into the cash flow available for dividends and growth.
There's one more big risk we have to mention. You hinted at it. The oversupply Lollapalooza.
Ah, yes, the Sunbelt problem. Look, building storage is easy. Zoning is way easier than for apartments. Construction is fast and cheap. So during the pandemic boom, everyone and their brother built storage facilities in Texas, Florida, and Arizona.
They were chasing the migration trends.
Exactly. But now all that supply is coming online at the exact same time that migration is slowing down. So we are seeing specific markets where street rates are just collapsing because there are simply too many empty boxes.
So if you combine a recession, which is a demand drop, with this oversupply, which is a supply glut,
you get a perfect storm that completely breaks their ECRI pricing power. That is the core bear case, that this is a cyclical peak and we are about to slide down the other side.
Okay, so knowing the bull case, the Moat, the tech platform, and the bear case, the rates, the oversupply, how do we value this thing? Is today's price of $146 a fair price?
Well, valuation is always more art than science, but we can triangulate a bit. As I mentioned, the market is paying roughly 17.8 times FFO.
Okay.
To justify that multiple, you effectively need to believe they can grow their FFO per share at about 4 to 5% annually, into perpetuity.
4 to 5%. With the life storage synergies kicking in and the ECRI hikes, it actually feels achievable.
It feels like a low hurdle. It's not a slam dunk by any means, but it's doable. It's a reasonable expectation.
What if we look at mean reversion? If we assume the market eventually values them back at their historical average multiple of, say, 20 times FFO.
Then you could build a case that the stock is worth about $170 by 2026. That offers some decent upside from here.
But if you take a more conservative view, like a dividend discount model, let's say you model a 4.5% yield plus 4% growth.
You land right around $148.
So basically, we are trading almost exactly at fair value.
We are. There is no big margin of safety here. You aren't buying a dollar for 50 cents. You're buying a dollar for about $1.
So the buy zone for the value investors listening would have to be lower.
For me, I'd be much more interested in the $130 to $135 range. At $146, you're paying for quality, but you are not getting a bargain.
Fair enough. Now let's zoom out. Let's look at the 5 to 10-year horizon. Because the world is changing so fast. E-commerce is eating everything. Is EXR just a landlord, or can they pivot and become something else?
This is the pivot that really excites me, actually. The potential move from landlord to logistics.
Right. We talked about how they have 3,700 locations. A lot of these are in dense, valuable urban environments.
Incredibly valuable dirt. And in the world of Amazon and same-day delivery, the biggest bottleneck, the most expensive part of the journey, is the last mile.
Getting the package from the big distribution center to your actual doorstep.
And EXR could counterposition themselves against the big industrial REITs like Prologis.
How so?
Well, Prologis has the massive warehouses way outside the city. EXR has the small nodes inside the city. Imagine a world where small businesses start using EXR units as micro-fulfillment centers. A local plumber storing parts, or an Etsy seller running their entire inventory out of a climate-controlled unit.
Or even Amazon itself, utilizing them as secure pickup lockers to reduce package theft from porches.
It transforms the asset from a dumb box to a smart node in the modern supply chain. If they can execute on that, and with their tech platform, they are by far the best position to do it. The multiple the market is willing to pay could expand significantly.
And the consolidation will just continue.
Oh, absolutely. The industry is forming an oligopoly right before our eyes. It's going to be Public Storage, Extra Space, and CubeSmart. They're going to eat all the small fish until they control 30, 40, maybe 50% of the entire market.
And oligopolies are very, very good for profit margins.
Very good for shareholders.
So let's wrap this all up with a final synthesis. Can you summarize the thesis for us?
Sure. The bull case is this. It's a synergy machine. The life storage integration delivers over $100 million in free cash flow. Their tech advantage widens the moat every day. And the ECRI algorithm allows them to grow revenue even in a slow, flat economy.
And the bear case?
The bear case is the rate trap. High rates compress NAV and limit their ability to borrow for M&A. The housing freeze kills demand from people moving. And that oversupply in the Sunbelt breaks their pricing power.
Okay, so final verdict.
My verdict is quality score is high GH. This is a blue chip, best-in-class business. The valuation score, though, is fair.
And your expectation?
My expectation is that this is a boring, durable compounder. You should expect something like a 9 to 11% CAGR. That's total return, including the dividend. It won't make you rich overnight like some crypto coin, but it's also highly unlikely to go to zero. It's a bedrock portfolio position.
Bedrock. I like that. Now, before we sign off, I want to leave the listener with one final provocative thought to chew on.
Okay.
We touched on the housing freeze, the idea that nobody is moving because they are locked into these amazing 3% mortgages.
Right. And conventional wisdom says this is bad for storage because the life events, the 4Ds, are down. Less moving, less demand.
But I want to propose the inverse. What if the housing freeze is actually bullish for storage?
Walk me through that logic.
Think about it. You bought a starter home 5 years ago at 3%. Now you have 2 kids. The house is bursting at the seams. Normally, you would sell and buy a bigger house.
Gosh, you can't.
You can't, because a new mortgage would be at 7%. You're trapped in a house that is too small for your life.
So you can't move your body, but you have to move your stuff somewhere.
Exactly. The storage unit becomes the external closet or the extra bedroom that you can't afford to buy.
Yeah.
The housing freeze might be creating a new permanent class of renters who use storage not for a temporary transition, but for long-term survival in a broken housing market.
That is a fascinating inversion. So if mobility dies, clutter just accumulates in place. That completely shifts the thesis from event-driven to lifestyle-driven.
It does.
And lifestyle tenants, they could stay for years, not just months. That's a much stickier customer.
It's something to chew on.
It definitely changes the risk profile. Wow.
All right, that's a wrap for this deep dive into extra space storage. We hope you enjoyed dissecting the concrete box business with us.
Thanks for listening, everyone, and don't forget to check out that affiliate link in the description if you want to support the show and get started with your own portfolio.
We'll see you in the next deep dive. Bye for now.